Is now the time to dump your stocks and panic like everybody else in the markets. If you have money in the stock market, just sit back and relax. Drink your favorite cup of tea or coffee, walk the dog, do some yoga, focus on work or the kids again. This is not the moment to dump your stocks. Human nature is our worst enemy when it comes to investing. We see the sea of red on the TV and we naturally want to run. It's the same instinct we have when we see fire. Just consider this, the S&P 500 index, what most people refer to when they talk about the stock market, has gained 220% in the last 6 years. Anyone who's had money in the stock market in recent years should be taking a lap of honor. It's been a very smart move. The so-called plunge that we experienced on Friday and on yesterday, Black Monday, is really just a little shave. Even after all this turmoil, the S&P is only down about 10% from its all-time high that it hit at the end of May. It's enough to be classified as a correction, but barely. Long term, this correction will be a good thing. Do not panic at this point. It's better just to sit back and let this play out, and then look for attractive opportunities. The only reason to pull your money out of the market is because you honestly believe we're on the cusp of a great global depression that we won't be able to climb out of for many years to come. There just isn't much evidence of that. The world's two biggest economies, the US and China, are still growing. China has problems, but the debate is whether it's growing at 7%, as stated by the Chinese government, or 2 to 5% like many experts now think. Either way, it is still expanding. It's just not expanding as strongly as it once did. Meanwhile, the United States is actually doing pretty well, with a good but not great growth. The US economy is expanding at about 2% this year, and more Americans have jobs. Unemployment is at its lowest level since before the last recession. There are definitely problems in many countries around the world, such as Venezuela and Brazil. But even if there is a global slowdown, the US and China are coming into it from a position of relative strength. Stocks are the best way for regular people to grow their money over time. Since the 1920s, stocks have averaged about 9.5% returns a year, and bonds have averaged about 5% returns. And if we look at the past decade only, stocks have averaged about 7.5% returns, whilst US bonds have given investors under 5%. That doesn't mean that every year is a great year for investors, but it does mean that over time, sticking with stocks grows your money the most. According to Fidelity, those who stayed invested during the financial crisis, for example, recovered faster and are doing far better than those who dropped out of the market in 2008 and in 2009. If you take your money out of stocks, you have to pull out and get back into stocks just at the right time. Remember, you have to get both decisions right. Otherwise, you might miss out on some losses, but you'll also miss out on some gains. That will cost you over time. The worst time to decide to get out of stocks is when it's falling or right after a big drop, as we've just experienced over the last week. It is likely to be a rough few days, maybe even a rough few months for investors. But unless you need cash very soon and can't afford to take any losses, stay invested and stay optimistic. History shows markets go up over time. This is Pedro Robert, the founder of the Wealth Insider Network, wishing you success in your investing. Goodbye and thank you.